Good afternoon, everybody. Happy Friday, and welcome back to the weekly market analysis for the week ending January 26th, 2024. This is the last Friday of January. Next week, by the end of the week, we will be in February, so 1 month of the 2024 trading year will already be behind us. And we're going to look ahead and see if things are setting up exactly the same or similarly to the way they were at the beginning of 2023 and see what the prospects are for continued increases across risk assets as we go into this year. And we'll get into it in just a moment, but I just want to remind you to hit the like button and subscribe. And you can follow me on Twitter at Mr. J. Thomason. And you can follow my weekly newsletter at befinanciallyfree.substack.com. It comes out every Sunday morning at 11 a.m. Eastern Time. So if you want some free market insights, data analysis, positioning, and so on, you can check that out. And the links to both of those are in the description of the video below. What you're looking at here on the screen, just to kind of go over a few things with you guys. The kind of the background of the chart here, I created an overlay for basically kind of to reflect what market regime we are in, whether it be an inflationary regime, a deflationary regime, and so on. And obviously, those regimes don't necessarily dictate the direction of price. Because, like, for example, you can see how blue, so in this case the bluish background is deflation, and in deflation it doesn't mean that that assets must go down. It depends on the asset class. Certain asset classes perform better than others, and there are obviously lots of other factors that go into the direction of asset markets. You can see when we had an inflationary cycle, or inflationary market regime, the markets were down over time. If you go back, you have green reflation and yellow Goldilocks, and those are typically good for risk assets. You can kind of see during the COVID period, post-COVID period, it was more deflationary, inflation and then deflationary. That's built into the system, so I just want to explain that right off the bat, so that way there's no confusion about the colors meaning something. I don't want anybody to think that it must mean caution or anything like that, just to give you the idea. And then I've also got a MACD here below, in the pane below, because I want to go over a few different things with you guys regarding the markets. But before that, let's just take a step back and look at where markets have closed at or are closing at. See, I'm looking on futures charts. And this is the S&P futures, and it looks like in the next couple of minutes we're going to close right around this 49.14, 49.15 level. And so obviously the big news over the last week was breaking to new all-time highs, and things that usually generates a lot of excitement, usually generates a lot of buying, because a lot of attention is made when there are new all-time highs. So that's obviously something to consider. Obviously, the psychology in this is important, because if everyone, if there's excitement, then you would think people are buying. But then on the other side of that, if you believe that everyone else is thinking that, then you might think, oh, the trade may already be crowded. Maybe everybody else, or maybe everybody else is thinking, oh, I'll go short because everyone else is going to be thinking about going long. Or maybe because everyone thinks everyone will go long, everyone will go short. So there's all kinds of different ways you could try to interpret this, but obviously you got to let the charts do the talking, let the technicals do the talking. And one of the things that I pointed out in last week's video, and you should go check it out if you didn't see it, is that on this breakout, which really kind of barely broke above the ascending trend line, which was kind of the main channel on the S&P. Once we broke that, even though it was just barely, what I had said was, if we just review, I had described that one of two things would happen, because if we zoom in, you can see I've got a red horizontal resistance line, which now ought to actually be green because it's going to be support, and we have the green horizontal, and then we have the white ascending trend line. And I said that what probably will happen is one of two things. We'll either come and then retest this this trend line, this horizontal trend line, and then go off from there and resume. That's one possibility. That's kind of weird that the lines are doing that. Or the other possibility is that we get above this ascending trend line and continue off from there. And I actually, in my opinion, I said last week, you can go check. I said that I thought that this option was the second option, where it hits the ascending trend line and continues higher from there, is actually the more likely option. And it kind of looks like, at least through this first week following all-time highs, that's actually what has transpired. Um, and so it kind of looks like we're establishing kind of a new range above our channel, which obviously that can happen. Just because there's a channel here doesn't mean that it must stay in that channel. And so at this point, you just kind of it's price discovery, and you just kind of got to kind of watch and see, uh, you know, where the trend is. Not necessarily in terms of direction, because direction is obviously up. But where are the levels and the trend lines that the market is actually going to be respecting? Anyway, this looks, from a technical standpoint, if I'm just looking at the price on the chart, and if I'm looking at the trend line break, and then the way it has sort of resumed off, although we could have a debate about whether it's resumed off, it looks pretty bullish. And then one thing I want to talk about also is, today we got PCE data. We've gotten a lot of data releases over the last week, or a number of different data releases, and I'll go over a few of those things. But what I want to point out to you is a few things on the PCE data. Some of it is income related and compensation related. So of note, I would point out that the personal income ex transfer payments, the rate of change has actually accelerated. Real disposable personal income has accelerated. Compensation has decelerated slightly, but is still well above, on a year-over-year basis, well over its pre-COVID trend. And a lot of people have been giving attention so far today to the drop in the personal savings rate. So obviously, on a rate of change basis, it's coming down, and it's at a 0.3% year over year, when its pre-COVID trend is 2.3. And frankly, I think a lot of people are misinterpreting this. If you look at Zero Hedge or other sources online, they would talk about how this is bad. Americans are strapped for cash, and so on. What I would point out to you is, if you actually look at this chart, which I'm going to pull down, let me see if I can get this. I'm having some problems here. Sorry. Let's see if I can pull this one forward. All right, there we go. This is the personal savings rate over time. You can kind of see, if you follow obviously you can see that what the kind of trend area was. We are definitely below trend. However, the spikes that you see, other than there being a spike in first quarter 2021, usually the spikes coincide with recession. And I think, let me see if I can. I didn't plan this ahead of time. I should have, but maybe if I can pull this chart back a little bit more, you can kind of see, it's obviously, it's spiked a lot higher during the period from COVID, but you can kind of see a few spikes, like when you go into the great financial crisis, it had been going down, spiked up, and so on. And so all that is, I don't really take a whole lot from that, but all I would say for sure is that anybody who is trying to tell you that the savings rate going down is showing that consumers are strapped doesn't really, honestly, in my opinion, know what they're talking about. And if you go to spending is up across the board. Services and goods, especially goods, spending is going up. So consumers are consuming at a higher rate than before. So that's obviously showing consumer strength. To me, that supports this idea that they, rather than everybody focusing on the personal savings rate, they actually have, if you look on the right side, and obviously the employee compensation chart, they have a lot of, they've got more money. Consumers are doing strong, and it shows in the spending data. And then the kicker on top of this is PCE inflation data, which came out, which obviously you're still seeing on the red bars, you're still seeing well above 2% on the year over year basis. But what's really actually really good, sort of, depending on how you interpret it, is if you look at the kind of bluish bars, you see headline PCE was at 0.5% on a 3-month annualized basis. Core PCE, this is the first time in a number of years that we've gotten core PCE below 2% on a 3-month annualized basis. And this is, to me, this is notable. And I'll talk about that in a minute. But even median PCE and trimmed mean PCE, their rates of change have come down significantly. They're both below the 3 level. So let me talk about this. So actually, let me show you the headline and core PCE charts on the time series. So you can actually see this is this 3-month annualized at 1.5% is among the lowest that we've seen in a really, really long time, going back to 2020, right, post COVID. So the thing I want to really talk about here on core PCE is my theory for a long time. I can't even remember where I wrote about this. It was probably in my newsletter. I probably put it in a video at some point last year, or maybe even in 2022. But I theorized that what we would have to see is we'd have to get the year-over-year time series of core PCE under the Fed funds rate, and it has been for some time, obviously. But then on top of that, we needed to get the 3-month annualized core PCE below 2%. And that if both of those things happened, that the Fed would have the clearance to declare victory. And then now it's a matter of interpreting what their next move is going to be. Do they feel like inflation is vanquished enough that they can actually cut, or can they definitely give the all clear in terms of saying, okay, we will not raise rates? Because one of the things that they've continued to push back on in recent weeks and recent months is this idea that, they're never going to hike again. And so they've actually continued to say that they are ready to raise rates again if conditions change. But in this case, I kind of feel like they have the ability to come out and actually say, yeah, we don't believe that we're going to need to raise anymore. And even, a lot of people will look at the dot plot and all the dots are lower for the end of December 2024. And so everyone assumes that means they won't hike again. But you could, across 8 meetings this year, you could hike and then cut a couple times to get down to that level. So I think that if the Fed, one of the things that we could watch for next week is if the Fed offers any clarity that on this idea that maybe they really will actually be done on the rate hikes, and kind of give the markets the all clear on that. So I think there's considerable upside risk because kind of what's been hanging over the market's head is this maybe on the rate hikes. So if the Fed comes out and says, yeah, we're definitely not going to ever hike rates again, and actually the door is much more open for a cut and relatively sooner rather than later, then that would, I suspect, let the markets really run from there. So I think that's kind of interesting. On the other side, one of the things that I wanted to point out was, and actually it's really interesting because of the way that the futures just closed. So on the chart, what's really interesting is that I've been keeping track of on Twitter for some time, and probably looking at the NASDAQ is the better option here. But on the NASDAQ, one of the things I've been watching is these divergences on the MACD, and this is why I have the MACD up on the screen here. So maybe I'll just pull this up a little bit more. So you can see as price actions coming up, one of the things that you could do, that you can use the MACD for, is you can look at the histogram for a divergence. So obviously if price goes up, histogram goes up, price goes down, histogram goes down. If the histogram comes up and makes a lower high, price makes a higher high, then it's possible that divergence will play out, and that means um, that the price will come off. It's not a guarantee. It is just something to watch for. So I can give you an example on the daily chart of a time where it succeeded, and a time when it failed. So if you look first here, we have early 2023. We had a situation where the MACD histogram was up and the signal lines were up, and then it came down, and then price made a higher high. You can see on the chart, but the histogram made a lower high. So this would be a divergence, right? And not just the histogram, but also the signal lines made a lower high. And then we started to come off, but then this was right around the time where a lot of the kind of AI mania was starting to happen. And so, and then of course we had the BFTP that had been created in March, which kind of staved off the collapse of multiple banks and things like that. And then price ended up taking off into the summer. So that happened. And then it's interesting too, because then if you just go forward on the timeline a little bit, the same thing took place just a few months later, right? We had the MACD came back up, histograms up, signal lines are up, crossed back into negative, came up again, green histogram, and made a higher high, but on the price, but then the histogram was a lower high, and the signal lines made a lower high. And then if you remember what happened after that, the NASDAQ fell, what was it, like 9% or 10%? If you go from, top to bottom, almost 12%. So obviously that was a situation where the MACD played out, where the histogram divergences and the signal line divergences played out. And the same thing is true on the other side too, when you're talking about when price has been coming down and you get that divergence to the upside, because that happened as well in to a degree in the summertime, and it happened last year too as well. So like during the bear market. So what I'm watching here, you can kind of see we got a divergence. We've had a couple of different divergences actually. So we got this first divergence where price came up, histogram went negative, or went red, came back up, made a higher high on price, lower high on the histogram. This is going into the new year, so this is when price started to pull back a little bit. And I was vocal on Twitter watching this, pointing it out. It obviously it did come down for the first couple of days into January, and then we obviously took off again. And what's really interesting now, the one thing that I would call out on this is to point out that despite the fact that the histogram made a lower high, the signal lines made a higher high. And so despite the fact that there's a histogram divergence, it wasn't confirmed by a MACD signal line divergence. But this time now, just less than a month later, we do have that development. We've got the MACD having come up. Today it's the MACD came down, so that obviously is the divergence, and the signal line, well, so far it's showing divergence, I should say, and the signal line is also making a lower high despite price making a higher high. So this is a situation where it's possible this pulls back. Now, I don't see any reason to believe why price will, for a number of reasons, which I'll talk about shortly. But I do want everyone to be aware there is a possibility. Now, no matter what the data says, no matter what positioning says, there's always chances that price pulls back, right? There are no guarantees. So that's why I think it's helpful to be aware of possibilities. So if you were interested, I mean, basically, if you were trying to short stocks for the last year, you've been destroyed, right? So hopefully, if you've tried to short stocks over the last year, you've risk managed well. But in any case, um, so you've got a situation where you've got clear risk to reward because the Nasdaq had made a local high. If you go to the top wick, 17,793 and 50 cents, and then if you're wrong if price goes back above, but price could also fall, 5% or something like 3%, 5%. If you look at the tide indicator, which price tends to attract itself back to the tide line, at least. The tide line from where we closed today is a little over 5% below. So, I mean, if you think about the risk to reward, that's, like 3 to 4 to 1, 3 or 4 to 1 in terms of risk to reward to the downside. And with clear risk management, you would basically put a stop like right there above the high of the last couple of price bars. And you're getting like I said, you get a pretty good risk to reward on that. So that is something that I wanted to call out as a possibility. However, if I go back to my data charts here for just a moment, if I just go to the business cycle indicators, we're going to get an update on the employment numbers next Friday. But one of the things that's interesting to look at is, if the PCE numbers, you can obviously see the far right, and then our retail sales numbers just blew out of the water in terms of rate changes in the rate of change, just a huge acceleration. So again, the consumers are still spending. And so as long as consumers spend, the economy will still be good, at least from a holistic standpoint. And as long as the economy is good, then you can expect that a large percentage of earnings are going to beat their estimates. Obviously, that we're in a period of time now where estimates get revised lower all the time. So I don't think that the bar is very high for earnings beats to take place. And so I think we can get some surprises. Now, having said that, I know that some of the tech earnings and some of the other earnings reports that have come out recently have had some how can I say, they've fell below estimates or came in below estimates. So I know that has happened, but I just don't think that the bar is super high right now for earnings beats. And next week we're going into some of the most important earnings from some of the mega cap names. So I think that that's something to point out. Another thing I wanted to point out, though, and this is kind of where I'm coming from here. This is my flows chart. So the gray bar is data from October. The blue bar is data from November, which is the most recent fully updated non-estimate data. And then the orange bar is the estimated flows data from December, and then the green bar is the current as of the most recent week estimate flows data for January. And what I'm highlighting here, or what I want to highlight specifically, is you notice that the green bars are really low for the equities here, on total equity and domestic equity and on world equity. But then the bond bars are high, well above zero. And what I'm calling out is that this is the same dynamic that we saw at the beginning of 2023. The same kind of thing took place where the stock flows were down pretty significantly and the bond flows were up. And what I was thinking about was that, like, if you think about what the narratives were at the end of 2022 and going into 2023, everyone was talking about 99% guarantee of recession. Everyone was positioning into long bonds and positioning into short equities, and that kind of set the stage for the massive rally across 2023. And despite the fact that there have been some times over the last few months where, like, obviously you can see the equity was up, and then back in October the bond was down. But despite that, you might see, we're kind of setting up the same sort of situation that we had at the end of 2022 going into 2023. And so that has me wondering if we're not set up for another pretty significant run in the year ahead in equities. And I'm not saying that the bonds are going to collapse like they did across quite a bit of 2023 and especially in 2022. But I think it's setting up in such a way that this could be another surprising year. And, why is that important? If like if you were to go back, let me actually go to a monthly chart and we'll go to sorry about that. We'll go to a log chart here. Let me shrink this down. One of the things about that is like I'll go back to actually let's go to SPX. That'll make this a little bit easier. We'll have some more room. So on SPX, if you go and you look at the period from basically the mid 90s to the when the dot-com bubble happened, just from if we go from January 1995, let me turn the magnet on. January 1995, so the beginning of 1995 to the end of December 1999. So basically 5 years, 95, 96, 97, 98, 99. S&P was up 219% over the course of that year. So if you want to do it by on a month-by-month basis, if you go from the beginning of January to the end of December 95, 34%. If you want to do the same thing here, 20% on the next year. If you want to do the same thing here, 31% in 97. You could do the next year as well, 27%, and then the last year, 19.5%. So around 20% or higher for 5 years straight. So, if we go to today, right? So we just had in going from January 2023 to the end of December 2023. That's 23%. S&P was up 23%. So because the S&P tends to, on average, or has for the last like 40 years, gained 9 to 10% a year on average, people are assuming, 23% is so high above that, it can't possibly do that again. But as far as I can tell, I mean, this could be if 95 to 99 repeated, then this is just the first year of 5 straight possible years that equities could go up 20% or more. And so I just say that because you can't get yourself locked into this belief that that the stocks have to come down, right? And if what I said before about recession or the possibility of recession is any like honestly, like it does not look to me like we're going to get a recession. Now, that's based on, again, the consumer is strong enough. I guess the one caveat on that is when you look at the inflation data, whether it be the PCE data or whether it be the CPI data, the thing that I would be concerned about is this turning into deflation. But in order for deflation to really happen, you have to get employment to break, which means you have to get consumers to break. It's hard to see that happening right now. Now, there are various catalysts. We've got job numbers next week. We've got a QRA from the Treasury. So the issuance could affect things because if bond prices and bond yields change to a significant degree that it puts tightening pressure on markets, then obviously this could change things. But right now it's hard to see any situation where we get a hard landing, the recession. So with that in mind, if you're looking at the charts and you're making investment choices like, oh, well, the markets have gone up 20% and they only go up on average like 9 or 10% a year, so obviously they won't perform like that again. And you've got a lot of people on, CNBC and otherwise talking about like, they'll look at something like Nvidia, right, which has obviously, we know the story has been on a tear since early 2023, actually even October 2022, and definitely across 2023. trading at $610. And people are saying, oh, like whether it be Nvidia, whether it be the whole S&P 500 or whatever, people keep saying, oh yeah, like it's the price has been going up, but what if valuations at those valuations, investing in it now isn't going to make any sense because you're not going to get that sort of gain again. So what if, like, basically what they're trying to say is that prices all the way up there, they're trying to make it sound like for the next 10 years price is just going to go like this. So they're trying to act like, oh, if you buy now, you're not going to get anything for years, like you're not going to make anything for years. If that's the way that you're thinking about the market right now, I mean, I don't know what to tell you. Like you cannot, like, you can't assume that price is just going to go sideways. You can't assume that, because we got these gains so like such high gains in 2023, it means that we can't have the same kinds of gains or even more in 2024. It's just not the way to do things, right? And honestly, the positioning is set up in such a way, and the flows are set up in such a way, and sentiment. Haven't even talked about sentiment. Sentiment has gotten better, less bullish. So even the sentiment gives you room, and sentiment isn't even everything. Sentiment gives you room now for continued price movement to the upside. So all I'm saying is, like, we could get a pullback over the next couple of weeks because of that, like the MACD signal could be signaling that we have a correction coming. But in the next 3 months, 6 months, 12 months, like, the economy is lining up well for stocks. The sentiment is lining up well for stocks. The positioning is lining up well for stocks, and just in terms of people, the way that people are viewing the markets generally, there's gonna it's if it just keeps running, we could trigger a performance chase, and that's what I would be concerned about here. So, a couple other things I want to just briefly take a look at, just to get our bearings straight. DXY is kind of between its tide and control line. That's something I'm going to be watching for. If price can get above, and stay above and get another tide cross, that would be supportive of the view that a near term correction is happening. The 10-year yield, I talked about the tide cross, bearish tide cross last week. What I really want to see is this thing sustain that bearish tide cross. And right now, like, I mean, ever since I talked about that, the yield has actually gone higher, and I think this is, well, the yield is at the same place it was last week essentially, and it's a little concerning because this tide cross, like, just like I've said before, previous tide cross in May 2023, and then the tide cross from August and September of 2021, those didn't mean a whole lot. And so when prices kind of hanging around at the same level as the tide line shortly after a cross, that usually is a sign that the cross might be a false cross, or might end up being a false cross. So I'm going to be watching this as well to see if we get any momentum to the upside. And for the yields, just for everyone's information here, on the yield, the QRA next week is going to be the biggest tell. If the issuance is high, or higher than expected, I should say, then that's going to cause the yields to rise, and then we'll probably go back to a bullish tide on the yield, and that's obviously something that you don't want to see if you're a bond investor, and you don't want to see that, especially on the long end. You don't want to see long yields go up. You don't want to see duration go up, because that's going to be bad for particularly the tech stocks. It would be like a similar situation as what happened in the late summer and into the early fall. So that is something you want to be aware of. And then finally, just checking in on breadth. We've got breadth that's hanging in there above the 50 line, so that's generally good. It's not really collapsing. It's kind of staying around the 75 level. That's healthy. And then stocks above their 200-day moving average, not at any real extremes right now. So there's a lot of room, like I said, for the market to continue to go. And then gold, I could say a lot about gold. I'll spare you. I would be careful about these moves in crude oil right now. I think a lot of people are buying um, the conflict in the Middle East. A lot of people, it's very similar attitudes as back during Israel Hamas, um, which was back in October, which that didn't go anywhere, and a lot of attitudes from post Russia Ukraine, where oil did spike, but then it was coming down. And basically, this entire way, everyone kept saying, "Oh, this is the time. This is the time." Now could be the time, but I would reserve judgment on this because there's been a lot of really frothy like news out there that should give oil a bid, um, and so I would just reserve judgment on that. It does look like it is bottoming, but I'm gonna want to see a tide cross for this to be really convincing. So I'll stop there. It's a long video today. Sorry about that. Thank you all for tuning in. I hope you guys have a great weekend, and I'll see you guys next time.